I recently picked SPYI as the one ETF I'd rely on for infinite dividends. But what about SPYT and TSPY? Stay tuned as I break down the options and give you my thoughts. I'll also go over updates to my small account margin portfolio. I'm on the hunt for an infinite stream of dividend income. It begins with my plan to turn $1,000 of Robinhood's money into $1,000 of my money. Before we revisit my SPYI decision, I'll share some brief updates on my small margin account. And remember, none of this is financial advice. You need to research your own investments. I received 2 dividends during the week. Nivy paid about 43 cents per share, which continues a slow decline. The distribution has fallen 3 weeks in a row, and this amount represents the lowest of Nivy's 16 payouts so far. I'm not panicking, but this is a trend I'd like to see broken. On the website, Granite Shares reports a current yield of about 99%. Koi paid out 59.5 cents per share, keeping up its erratic trend, and is a big drop from last week's distribution. This is in the area of 80 or 85% yield. As with all my dividends, I reinvested half back into the funds and invested the other half into my forever fund, SPYI. The equity in my portfolio dropped to about $2,070 this week, which represents about a 2.5% drop. And unfortunately, that drop affected my margin, putting me back into the high risk category. I'm not really far away from where I was when I was low risk, but once you get under 5% buffer, you become high risk. Nivy and SNOI were flat for the week. Koi took a big dive, down 8%, but that's not anything compared to Misty. It was down over 16% this week. Ouch. Here's a different look at the portfolio as a whole. Overall, down almost 12%. Koi and Misty are now down over 30% each. The current yield for these is still pretty high, but the yield on cost is getting much worse. On a side note, I mentioned last week that Robinhood lowered the interest rates on margin, but not on uninvested cash. This week, they did lower the savings interest rate 0.25% to 3.75. I do appreciate that they notified me and didn't just reduce it without saying anything in the hopes I wouldn't notice. A few months ago, I wrapped up my small account margin strategy and chose the one ETF I hope will pay me forever, SPYI. When I made that video, TSPY was a newer fund and didn't have a full year of history. Well, now it does. SPYT was a strong contender with its tempting higher yield. However, I found that SPYT had experienced some NAV erosion. I ultimately chose SPYI because it appeared to be more NAV stable and utilized tax efficiencies that SPYT didn't. So I want to take a look back at my original decision and see how SPYI, SPYT, and the new contender, TSPY, stack up in today's market. All 3 funds are tied to the S&P 500, which means broad, diversified exposure to the largest U.S. companies. They all pay monthly and use option strategies to generate premiums, but they take different approaches. Let's start with SPYI, the fund I chose. It invests in the S&P 500 and utilizes a call option strategy, typically going out a month or more in expiration. The fund aims to generate high monthly income while maintaining exposure to the S&P 500's upside by holding the underlying stocks. It's recently been yielding about 12%. A major highlight is SPYI's tax efficiency. It uses index options, which are taxed under IRS Section 1256, meaning any gains or losses are treated as 60% long-term and 40% short-term, regardless of the holding period. Additionally, a portion of its distributions may be classified as tax-deferred return of capital, which can be a huge benefit for long-term investors. Its expense ratio is 0.68%. Next, let's look at SPYT. This fund is an actively managed ETF that seeks to generate income by holding a portfolio of ETFs that track the S&P 500 and selling daily credit call spreads on the index. Its objective is to target an annual income level of 20%. The fund aims for consistent monthly distributions, and it also owns the underlying assets. SPYT's strategy is designed to earn additional premiums compared to traditional option-based strategies by focusing on short-term call spreads. Its expense ratio is 0.87% and has recently yielded around 21%, a bit higher than the target of 20%. Now for the new contender, TSPY. This fund seeks current income and capital appreciation, aiming for exposure to the S&P 500 while generating income through options premiums. The current yield is about 14%, and it holds the underlying assets like SPYI and SPYT. The key to TSPY strategy is writing call options that expire the same day, known as 0 DTE or 0 days to expiration options. This approach seeks to capitalize on the rapid time decay of these options, generating consistent income. However, like other options strategies, it limits the fund's ability to fully participate in significant S&P 500 gains beyond a certain point. TSPY also offers a monthly distribution and an expense ratio of 0.68%. Now let's take a look at some charts. Since TSPY is the youngest of the three ETFs, we'll use the day after its inception date as a starting point. So each of these charts will have August 15th, 2024 as the start date. I'll start with dividend consistency on seekingalpha.com. I'm not comparing dollar amounts. Rather, I'm looking to see if the dividends hold steady, are really volatile, or if there's an up or downward trend. Looks like all three are relatively flat, meaning the monthly dividend is consistent. Each fund had a dip around April 2025 when the market was rough for the S&P 500. Nothing particularly concerning here. Now we'll look at share price return. I added SPY to the comparison so you can see the underlying index. Remember that income, not capital appreciation, is the focus of these ETFs. Still, if I'm holding an investment for the long term, I feel better if the share price is not diverging from the underlying's performance dramatically, as that would be evidence of NAV erosion. Going back to August of 2024, all three funds trail SPY, but this is not unexpected because these funds are trading some capital appreciation for income distribution. SPYI and TSPY have similar return rates, while SPYT is the only one with a negative share price return. Despite the fact that the S&P index is up almost 19%, SPYT has lost 7% in share price. SPYT pays out a higher distribution than the others each month, so it seems that the higher distribution comes at the cost of some NAV erosion. TSPY is the winner among the three funds, with SPYI trailing by less than a percentage point. Now, most importantly for an income investor is the total return chart. Everything is in a much tighter bunch in this view, with the three income ETFs closing the gap with the S&P. SPYI and TSPY are neck and neck, with TSPY ahead by less than a percentage point, similar to the advantage TSPY had in the share price return chart. SPYT is lagging just a bit behind at around 15.5%. TSPY at just under 19% return is impressively close to SPY at about 21%. A quick look at totalrealreturns.com shows us how they compare on worst drawdown. Although they are all similar, SPYI is the winner here. This stat may be more important to those who use margin. So now let's talk about the pros and cons of each. SPYI's NAV stability has been solid. Unlike some option funds that slowly bleed value, SPYI has managed to hold its ground, even growing slightly. It had the second highest share price return and total return of the funds during the August 24 to present period we reviewed. It was really close to being at the top, less than 1% below TSPY. The fund takes advantage of tax-efficient strategies, and this is a big deal for taxable accounts. And looking at worst drawdown, SPYI beat the other funds. The main con to SPYI is the yield. While strong, it isn't the highest among its peers. If you're chasing maximum income, SPYT and TSPY might look more appealing. So the bottom line for SPYI, it's a balanced, stable, tax-smart investment. This is why I originally picked it, and I still feel good about that choice. Looking at SPYT, its biggest pro is the huge income. If you want raw yield, SPYT delivers. A 20% target paid monthly is hard to ignore. It also has consistent distributions because of the explicit target. You know from month to month about what you're going to get. But it does have some cons. That 20% doesn't come free. The NAV has been slipping. Since its inception, it's lost over 8% in value, while IVV, the underlying index, is up 15%. Because the fund promises a fixed income target, it may be forced into strategies that sacrifice long-term stability. In other words, will the 20% target sometimes force it to make decisions that compromise the long-term gains for short-term victories? SPYT has the lowest total return during the period we examine, and it has the highest expense ratio of the three funds. So my bottom line is that SPYT is income maxed, but at the cost of NAV health. It works great if you want to maximize cash flow now, but over years or even decades, that erosion could be hard to swallow. TSPY supports a higher yield than SPYI, but without setting a hard target like SPYT. This gives more flexibility in managing payouts. Like SPYI, it has been able to maintain NAV and grow some, and it has the highest total return of the three funds, edging out SPYI by less than a percentage point. But it's still a newer entrant, and it may take more time to prove itself. It also doesn't have the same tax efficiency focus as SPYI, but it does anticipate about 80% return of capital. So the bottom line is TSPY looks like a compromise candidate. Higher income than SPYI, less NAV risk than SPYT, but it's also the newest fund, so we have the least amount of history to examine. So wrapping it up, SPYI is my pick for stability, tax efficiency, and balance. SPYT is the income monster, but with NAV erosion risk. And TSPY is the new contender, sort of sitting in the middle with solid yield and NAV stability, but still building a track record. So after a few months, has my opinion changed? Well, not really. My original premise was to find a NAV stable fund for the long term, and SPYI's tax efficiency and management style still align with that goal. Ultimately, there is no single best fund for everyone. It all comes down to your personal goals and risk tolerance. I'm happy with my choice, but I'm glad to see that there are more solid income producing ETFs on the market. Honestly, all three are good choices depending on what you want. Do you want maximum income? Then SPYT. Balanced and tax smart? SPYI. And perhaps a balance between SPYI and SPYT? Then TSPY. I actually own all three funds in a different account and plan to add more TSPY. Here's a look at my upcoming dividends. I expect to receive the MISTI and SPYI distributions at any time, so we'll talk about those next week. So let me know in the comments which of these three funds, SPYI, SPYT, or TSPY, is your favorite. And if you found this breakdown helpful or entertaining, please hit the like button and subscribe for future updates. And remember, none of this is financial, legal, or tax advice. I'm just inviting you along my journey. If you'd like to learn more about my small account margin strategy, check out the first 5 videos in the series. And good luck hunting those infinite dividends. Take care.